Are you starting to feel like an equity expert? Not yet, but I'm sure you want to start thinking like one. Yes? Well, then you are on the right track. We just spent the last lesson learning about the two ways of investing in equity. And we also saw why investing in equity mutual funds was a great start for anybody who is new to investing, as well as for those who don't really have the time. In this set of lessons, we're going to jump right into different types of equity mutual funds you can choose from. Up here, we see a list of all the funds we'll be covering in the next few lessons. Now, understanding the different types of equity mutual funds can be pretty easy. Just think of them as yummy cakes. To know what type of mutual fund you're looking at, you need to factor in the composition of its portfolio. Ask yourself, what type of stock and sectors is the fund made up of? Just like how for a cake to be called a cake, most of it needs to be made of cake batter. For an equity mutual fund to qualify as one, it must predominantly invest its corpus into equity shares. Now, let's look at the different types of equity mutual funds out there and the special ingredients that make each of them unique. In this lesson, we're going to serve up a mouth-watering slice of diversified equity funds. Diverse. I'm sure the word rings a bell for most of us. It implies some sort of variety. And that variety is precisely the main ingredient in this type of fund. Diversified equity funds have portfolios that invest in a variety of stocks, whereby the portfolio includes stocks or shares of companies from different sectors and companies of different sizes. For example, if an equity fund invests, say, 10% in the auto sector, 20% in the banking sector, and another 15% in pharma, and let's say the rest is invested equally in construction, cement, and retail sectors. That's when a fund is said to be a diversified equity fund. What happens here is that because these funds invest in different companies across sectors, they're spreading the risk associated with each sector. This means that the performance of your fund isn't dependent on the fortunes of any particular sector. Here, we can see an example of a diversified equity fund called the Aditya Birla Sun Life Equity Advantage Fund that makes diverse investments in sectors ranging from banking to pharma and even cement. And here we see how the SBI Magnum Multi-Cap Fund invests in stocks across banking, technology, and even oil and gas. Now, diversified equity funds come in different shapes and sizes, or rather large cap, mid cap, small cap, and multi-cap to be precise. That's not what we mean by cap. The term cap actually refers to market capitalization, meaning the value of a company in the stock market. And how is this value calculated? Simply by multiplying the total number of outstanding shares that a company issues with the current market price of that share. And here's how it all works. Large cap funds are funds that allocate 80% of their investment into large cap companies. That is the first 100 companies ranked in terms of descending order of full market capitalization. They're considered to be safer than the other types of equity mutual funds because it's hard to go wrong when you're backing some of the biggest and steadiest names in the business. Here is a large cap fund, Aditya Birla Sun Life Frontline Equity Fund. We can see how its portfolio is made up of many large companies like Infosys Limited, HDFC Bank, ITC Limited, Larsen & Toubro, among many others. Similarly, mid-cap funds invest a minimum of 65% of its investment into equity and equity-related instruments of mid-cap companies. These are companies ranked from 101 to 250 in terms of descending order of full market capitalization. Compared to large-cap funds, mid-cap funds tend to be riskier investments, though they generally give a good return in 3 to 5 years. Here is a mid-cap fund called the Sundaram Mid-Cap Fund, which invests in mid-sized companies like Ramco Cements, Apollo Hospitals, and RBL Bank. Now there is a new scheme called a Large and Mid-Cap Fund that invests a minimum of 35% each in large cap and mid-cap stocks. No prizes for guessing. That small cap funds invest a minimum of 65% of total assets in small companies, most of which are in their early stages of growth. These companies are ranked
below 250 in terms of descending order of market capitalization.
I bet you've also guessed that compared to large and mid-cap funds, the risk is higher when investing in small-cap funds.
Here is a small cap fund called Nippon India Small Cap Fund that invests in small companies like Navin Fluorine, Orient Electrics, and so on.
Considering that the risk associated with investing in small cap funds is usually higher, it turns out that the rewards can also be in proportion and considerably higher. And finally, we have general diversified or multi-cap equity funds, which are made up of stocks from all three types of companies: large, mid, and small. Make sense? Now, before you treat yourself to a slice, don't forget the one thing that makes all diversified equity funds the same.
They all have up to 100% of their portfolio invested in equity and equity-related instruments.
Now, I am sure you're wondering what makes diversified equity funds a great investment. Well, don't wonder, because you already know the answer. Firstly, diversified equity funds invest majorly in equity, because of which they're able to harness the power of compounding to give you higher returns. That's not all. Because this type of fund invests in a diversified portfolio, it greatly reduces sector and company-specific risks, proving in the end to be a great tool for long-term wealth creation. So be it multi-cap, large, mid, small, I for one think you know it all. Now, on to our next lesson where we get to know more about sectoral funds.